Spot Bitcoin ETFs shed $1.26 billion in worst week since late January as Ether. That single number resets the market's playbook. The key question is not what happened, but what changes next for operators and users. We will map trigger, incentive shift, and downstream impact before the close. That is what flowed out of spot Bitcoin ETFs in a single week, the worst performance since late January. And that is just the headline. Beneath it lies a signal about investor confidence that matters far more than the headline number itself. Spot Bitcoin ETFs were supposed to be the infrastructure that brought retail and institutional money into crypto at scale. Since their launch last year, they have attracted over $600 billion in cumulative inflows. But here is what changed last week. In just 5 trading days, investors yanked $1.26 billion. That is not volatility noise. That is sustained withdrawal pressure. The timing matters. Bitcoin had just crossed above 60,000. The narrative said momentum. The data said the opposite. Even as price climbed, money left the building. This is what contrarian positioning looks like in real time. When retail and institutions stop buying at higher prices, it signals the conviction story is breaking. But there is more. Ether ETF flows tell an even darker story. Ethereum spot ETFs, which only launched a few months ago, have now seen 10 consecutive days of outflows. 10 days. That is not a single bad day or a correction. That is a pattern. That is systematic redemption pressure. The combined crypto ETF complex saw roughly $2 billion in net outflows across the week. Why does this matter? Because ETF flows are one of the earliest signals of institutional positioning shifts. When big money starts heading for the exits, retail typically follows within days. The ETF ecosystem is designed to be transparent. Every redemption is visible in near real time. That means every investor watching knows that other investors are bailing. That creates psychological pressure. Here is the contrarian angle. Bitcoin advocates would argue that outflows at higher prices prove the market is maturing, that institutions are taking profits after a strong run. That narrative has merit. Bitcoin did rise sharply into that week. But the timing of the outflows suggests something different. They accelerated even as price stayed elevated. That is not profit taking on a reversal. That is conviction breaking at the highs. The second-order effect is in the narrative timeline. Bitcoin has had several high-profile institutional endorsements and ETF approvals over the past 12 months. Each was supposed to unlock structural demand. But structural flows depend on sustained conviction. If that conviction weakens at exactly the moment institutions should be accumulating, it suggests something fundamental in the thesis has shifted. What is actually happening? 3 possibilities coexist. First, some funds may be rotating into other assets, equities, treasuries, or commodities. The rate environment changed during that week. The Fed held rates steady but signaled a hawkish tone. That could have spooked crypto buyers into risk-off mode. Second, some institutions may be taking profits from earlier positions. Bitcoin ETFs have seen strong inflows since approval. Profit-taking is normal. Third, and most concerning for bulls, some investors may be losing conviction on the crypto narrative itself. The data does not tell you which is true. But the pattern tells you something. Money that was willing to flow into Bitcoin at 50,000 was unwilling to stay at 60,000. That is a demand curve that slopes downward instead of upward. In traditional finance, that signals a market peak is nearby. But here is what to actually monitor over the next 72 hours. If those outflows continue into the next week, it suggests institutional hesitation is real and sustained. If they reverse and inflows return, it was just a correction shakeout. The key number to track is daily inflow-outflow balance in spot BTC and ETH ETF reports. If you see 3 consecutive days of net inflows, the narrative resets. If you see another week of net outflows, the tide may be turning. For investors holding crypto, this is a timing problem masquerading as a narrative problem. The question is not whether Bitcoin will be valuable in 5 years, that is a conviction bet. The question is whether you want to hold the volatility for the next 3 months while institutions figure out their positioning. That is a risk calculation, not a belief system. For traders, this is a technical setup. Outflows at higher prices combined with sustained redemption pressure creates a framework where the next pullback could accelerate faster than normal. Institutional money leaving creates a vacuum. Retail tends to fill vacuums with fear, not hope. The real story is not the billion-dollar number itself. It is that the infrastructure designed to bring conviction money into crypto is now showing evidence of conviction leaving. That is the signal worth paying attention to over the next few days. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next.